Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Garrett DeSimone, head of Quant at OptionMetrics, to discuss the impact treasury volatility has on other areas of the market. Garrett, it's great to see you again. Welcome back to Trade Talks.
Happy to be back, Jill.
All right, and you got it. And treasury volatility implied from futures options measures investor uncertainty around 10-year prices. What is valuable information you can discern from treasury vol?
Well, embedded in treasury vol are investor expectations regarding future interest rate movements in the 10-year yields. So what we see there is factors regarding industrial production, uncertainty regarding future inflation, as well as monetary policy. And this uncertainty drives the direction of the options prices. So as investors become more uncertain regarding what future inflation is going to be, how much monetary policy is going to influence the level of money supply, that'll change the yield and ultimately increase the prices and the premium of these options.
So what does an increase in treasury vol create? Why does it create a drag on equities, particularly tech equities?
Sure. So an increase in treasury vol is a measure of an economic uncertainty. And when this economic uncertainty increases, investors, particularly in tech, find that there's uncertainty regarding discount rates. And since technology companies have a lot of their cash flow and their valuation derived from further out, that this creates uncertainty and tightens valuations.
And so, Garrett, when we take a look at treasury vol right now, where are we? What are you seeing? What are some dates that we should be aware of as we go into June?
Sure. Most importantly, we're looking at two core economic numbers, one being the unemployment rate, or the non-farm payrolls. And the second, and probably more important for tech, is the inflation numbers. So that is the core CPI. And in regards to how this is going to influence volatility in these big tech names, we expect this to act sort of like you would see in an earnings run-up. So we expect volatility in tech to be kind of jumpy over the next 2 weeks. And then with the news coming out, we expect the volatility to blow off. So in terms of what this means for vol strategies, for example, we expect this to act similarly to what the benefits to a long vol trade up into the news, and then possibly selling vol after the release of the announcement. And the reason we see this is investors become very uncertain and nervous regarding whether there's going to be surprise, let's say, unemployment numbers or surprise inflation numbers, which could, again, drive losses in the tech sector.
And I'm glad you brought that up, Garrett, because I was going to ask you how you're positioning in front of this, because on the flip side, it feels as if this has been a very sell the news kind of market. And we saw that with big tech earnings just this past quarter, where they had fantastic numbers, but it was more of a sell the news kind of event. And it's interesting to see that you're thinking in those terms as well when it comes to volatility. So what's an example of a position that you might be taking as you look at June 4th and you look at June 10th?
Sure. So a common trade is very similar to what has been profitable in the market over the last few years, which is long volatility, let's say long straddles into the news, and then selling vol upon the release of the earnings, or in this case, the economic news. And the reason being is investors are treating this like a mini earnings date, these macro news events. And the economic news has been the central driver for returns, as we can see in the equity big tech's exposure to treasury vol. So what we're seeing here is long vol strategies prior to the news, and then selling vol immediately before.
So when you're talking about long vol strategies, is this an NDX, QQQ, or using another instrument?
Absolutely. So big index trades, or even single name tech stocks. So common long volatility trade is buying a straddle, or you can sell some sort of measure of a hedge position, buying the underlying stock and selling a call into the news. So there's various ways to trade it, but all in all, it's long Vega exposure and long gamma.
All right, Garrett, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you, Jill.